My name's Chris Gosselin from Australian Fund Monitors, and I'm joined today by David Franklyn, who is the portfolio manager of the Argonaut Natural Resources Fund. Dave, welcome.
Thanks, Chris. Thanks for having me on.
So let's just have a look at the whole resources sector, because it hasn't really been setting the world on fire over the last 12 months. How have you handled that, where the ASX 300 resources is down 8% over 12 months? How's your own performance been?
So you're right. The ASX 300 resources is down 8%. Our fund was down 1.5%. So, the way I look at it is you go through periods as a manager where you're trying to make money and the market's very supportive. But then just as importantly, it's a matter of protecting the downside in tougher markets. So, we think we've done that quite well. The way we've done that really is by being very careful with our portfolio construction. So things like we've got 70% of the portfolio in companies with a market cap above $1 billion. We've only got 4% exposure to exploration type companies. And the underlying projects that the companies we own, 85% are either in Australia or North America. So we manage risk as best we can, and then we can also own reasonably high levels of cash, which we can also draw on.
So over the past 12 months, as the resources sector has been going through tough times, and it's obviously a very cyclical sector, has the portfolio, or how has the portfolio changed?
Again, a good question. I think the process that we go through, and perhaps if I can just sort of lead you through it, is, what we're looking for, firstly, is we're high conviction. So what we want to do is have a relatively small number of companies that we think will perform strongly. So that's typically between sort of 10 and 25 companies in the portfolio. Then what we do is we say, well, what are the key resilient themes that are going to impact on the resource market? Typically, that's energy transition and geopolitical risk. We see those as the key resilient themes. From there, we then choose the commodities that will benefit from that, and from there we choose the best quality, best value companies that produce or are looking to produce those commodities. And that's really the way we structure the portfolio. Now, what I would say is, while energy transition remains a key resilient theme, I think there's been a shift. The last couple of years, it's all been about electric vehicles and EVs as they penetrate the market, and it's been flavour of the month. So the commodities like lithium, nickel, graphite, rare earths have been flavour of the month, and that's where a lot of the activity's been. I think because of that, prices rose very strongly. Demand outstripped supply, and the response to that has been a remarkable quick supply response, particularly out of China. And so those commodities have now come back, and the EV market is struggling with a slower global economy where prices are still relatively high. So whereas they were key drivers of the resource sector in the past, I think going forward, it's a different group of commodities. We think that the focus now is on grid power. So if you look at greenhouse gas emissions, 15% come from transport, but over 60% come from energy generation and industry. And we think that's where the focus is going to be. So they're commodities like copper, like uranium potentially, and also gas as a transition fuel as we move away from fossil fuels into renewables. Renewables be important, but you need the backup base load until battery technologies reach a level where they can provide that.
So David, whilst you're based in Western Australia, you're incredibly leveraged to global trends in both supply and demand. I mean, you mentioned China, saying that China ramped up supply and that quickly balanced to the increased demand. What's going on globally at the moment is pretty tumultuous, if I can say that. You don't know whether, who's going to be in the White House from next year, and is it going to be drill, baby, drill, as Trump says, or is it going to be more energy related and alternative energy related? How do you handle that sort of uncertainty around the globe?
Well, I think it comes hand in hand with investing. So often the way I describe it is is you've got to observe and react rather than trying to predict too much. Look at the evidence and then act from there. What I would say is that China is fundamental to commodities demand. I mean, they in a lot of the key commodity markets, they represent more than 50% of demand. And so the strength of the Chinese economy is critical. And really, one of the reasons that we saw the market weak over the last 12 months has been the stimulus that the world was expecting from China as it came out of COVID didn't really eventuate. And I think what we're looking now is a Chinese economy that's probably going to chug along at a 4 to 5% growth rate, well below its historical levels. And I think the rest of the world just needs to adjust to that. I think if you look at the US, some different factors have been at play. And really the Western world over the last 12 months has been dealing with inflation and interest rates. And you've seen the market bounce around depending on whether inflation was taking hold or if it was easing, then an expectation interest rates would come down. I think where that's at now is interest rates, in our view, have peaked. And cuts are reasonably imminent. Whether that's September or whether it's December, who really knows? But I think certainly rates are likely to come down over the next 12 months, and we think that'll provide some support. Politically, a really good point. Does Trump get in or do the Democrats get in? Again, remains to be seen. I think as we go through, I think there's positives probably on both. Really, what Trump is about is low-cost energy to drive the economy forward. And I think, where he's talking about driving gas production, that's a component of it, but you'd also expect low-cost baseload power, low emissions power, such as uranium, will also get some support. But positively, he's about re-stimulating the economy in the US, which I think will be generally good for commodities.
I think your point saying that rather than trying to predict, you react is quite honestly a sensible one. If you listen to all the predictions, then you can listen to far too many of them. They don't always agree, and when they do always agree, it's normally counterintuitive time to take the other point. So reaction is really important. It sounds as if you've been able to do that. As you say, you've avoided the downside over the past 12 months. How quickly can you react to any changes, whether it be geopolitical or demand or supply?
Again, a very good question. The way I look at it is, firstly, you got to take a view on the world and on the market. So what we saw, 12 months ago was that there was increased risk. Whether that was geopolitically, economically, or even just in where commodity prices like lithium were going. So what we do in those kind of markets is we don't try and make a big portfolio call, but what we do is we stay exposed, but we lift our exposure to bigger market cap companies. So the benefit of that is if you do get a pullback in the market, one, you're in bigger companies, they'll generally fall less and they'll recover first because of their quality. But secondly, you convert to cash. So you can manage that pretty well. So, a really good example is what happened with the lithium market over the last 12 or 18 months. Really, no one in the market 18 months ago was forecasting lithium prices to be back where they are now. And it was really driven by a huge amount of supply coming out of China and Africa, which really the market hadn't factored in. We were generally cautious, and what we've done is exposed our portfolio to lithium, but through some of the bigger companies like Pilbara and Min Resources. So when that market started to turn down, we could exit the positions very quickly. And typically we take a view on the commodity, and we can go from 15 or 20% in lithium to 0 or 5% lithium literally within a day or so. So it enables you to move very quickly, which certainly helps.
If we looked at your portfolio at the moment, where would your exposure be based on individual commodities?
So look, the commodities that we like, the commodities that we have bigger exposures to are copper. We see that as being a fundamental position in the portfolio where demand is likely to outstrip supply for some time. So that's typically between 15 and 20% of the portfolio. We also like uranium as an emerging baseload. So that's around 10% of the portfolio. Gold, I think, is also a necessary part of the portfolio given the geopolitical situation globally. So that's often around 15%. Apart from that, we're also opportunistic. So we're looking at met coal, which is an ingredient in steel production. We don't really go to thermal coal, and we think there's better alternatives. And then some spot markets like tin and the domestic gas market on the East Coast, where there's an emerging shortfall there. So we're looking at alternative markets to perhaps the lithium and nickel and graphite and rare earths that would have been bigger positions in the portfolio last year.
David, what seems to me to be attractive about the portfolio and the way you manage it is that it's not subject to Australian political risk. So you're talking global themes, global trends.
Yeah.
So a short-term political decision here isn't going to dramatically derail performance. It's what's happening globally, which is much easier to see what the overall trends are.
That's right. Investing in resources, even if the companies are based here, the key drivers around commodity price, etc., are driven by international demand and supply. So there are some parts of the market in Australia which can have an impact. So, for example, as I touched on before, the East Coast gas shortfall creates an opportunity, which is really distinct from what's happening globally with the gas market. But in general, you're dealing with global international markets driven by demand and supply on a global scale.
David, the fund, obviously it's outperformed its index over the past 12 months, albeit the index was down 8%. But over the longer term, I think you're up 29% on an annualised basis, which is pretty impressive performance. That's sort of is typical of the resources sector. You're going to have times when you've got to avoid losing money, and then sort of sounds a bit glib, but make hay while the sun shines.
Well, I think that's right. We kicked off the fund in January 2020. Since inception, the fund's up about 180%, with an annualized return of around 28, 29%. So it's a record that we're very proud of. What I would say though is funds management's all about what you do going forward rather than what you've done in the past. The positive of going through the year that we've just been through is now there's better value. There's better value and better opportunities. So, we're very optimistic about what we can deliver in the future.
David, really nice to talk to you this afternoon. On behalf of Australian Fund Monitors and Finance News Network, thank you very much. We look forward to speaking to you again soon.
Thanks very much, Chris. Thank you.